What if I told you that the price of one single ounce of gold, something you could hold in the palm of your hand, just hit $5,589, not years from now, not in some sci-fi future? January 28th, 2026. A real date, a real price, a real record that shattered every single milestone gold has ever set in human history. And here's the question that every American, every worker, every saver, every business owner should be asking right now. What does that mean for me? Because gold doesn't just go up for no reason. When gold skyrockets like this, it's telling you something. It's warning you. And today we're going to decode exactly what it's saying. About the US economy, about the wars shaking our world, about your wallet, and about where we're all headed. Stay with us, because this story is bigger than gold. Let's start with the numbers, because they are absolutely jaw-dropping. At the start of 2025, gold was trading at around $2,224 per ounce. That already felt high to many analysts. Fast forward just 12 months, and gold didn't just go up a little, it exploded. By the spring of 2025, gold cracked $3,500 per ounce. By mid-2025, it blew through $4,000, a milestone that was once called almost impossible. By late autumn 2025, it surged past $4,500. And then, in January 2026, it broke through $5,000 and then reached an all-time record of $5,589.38 per ounce on January 28, 2026. Let that sink in. In just 12 months, gold went up by more than 113%. According to CBS News and the World Gold Council, gold set dozens of new all-time highs throughout 2025, roughly one new record per week. This isn't a blip. This isn't a trend. This is a full-blown paradigm shift in global finance. And as of right now, March 2026, gold is trading around $5,185 per ounce, holding firm even as geopolitical tensions continue to rattle global markets. Major banks like UBS have raised their gold forecast to $6,200 for 2026. Goldman Sachs and Bank of America are watching the same trajectory. The question is no longer, will gold keep going up? The question is, how high can it go? Now here's where it gets really interesting. Gold doesn't just go up randomly. Every time gold surges like this in history, whether it was in 1979, after 9/11, or during the 2008 financial crisis, there's a reason. And right now, there are 5 massive forces all firing at the same time, pushing gold to levels nobody thought possible just a year ago. We cannot talk about gold in 2026 without talking about war. On February 28, 2026, the United States and Israel launched strikes on Iran. This is not a proxy conflict. This is not a regional skirmish. This is a direct, full-scale military confrontation with one of the most strategically critical nations on the planet. And the markets reacted instantly. Oil prices jumped more than 13% overnight. Gas prices in the US surged to $3.20 a gallon, their largest single-day jump since March 2022, when Russia invaded Ukraine. Shipping traffic through the Strait of Hormuz, a narrow waterway that carries roughly 1/5 of the world's oil and liquid natural gas, ground to a near halt. When investors smell geopolitical fire, they do one thing: they run to gold. It's been this way for centuries, and 2026 is no different. Here in the United States, inflation may have cooled from its 2022 peak, but it hasn't gone away. As of early 2026, the U.S. Consumer Price Index stands at 2.4%, still above the Federal Reserve's 2% target. And now, with oil prices surging because of the Iran war, economists are warning of a second wave of inflation that could push prices even higher. According to Mark Zandi, the chief economist at Moody's Analytics, for every $10 increase in oil prices, U.S. inflation rises by 0.15%. When oil jumps 13% in a single day, that math adds up fast, and it adds up directly to your grocery bill, your gas tank, your airfare, and the price of nearly everything you buy. Gold is the world's oldest and most trusted inflation hedge. When money loses its purchasing power, gold holds its value. And right now, Americans and investors worldwide are betting that inflation isn't done with us yet. The Federal Reserve is caught in a trap right now, and it's directly impacting gold. Here's the situation. The U.S. economy grew at only a 1.4% annualized rate in the final quarter of 2025. That's slow, really slow. Before the Iran war, economists were forecasting stronger growth for 2026. Now, with oil prices surging and consumer confidence shaken, those expectations are being cut. At the same time, inflation is creeping back up. The Fed is supposed to lower rates when the economy slows and raise them when inflation rises. But when both problems happen at once, the Fed is stuck. Mark Zandi put it plainly, given the Fed is already clearly focused on inflation, this war would make it less likely they would cut rates further, And when the Fed is paralyzed, when the dollar's future looks uncertain, gold becomes the safe bet. It always has. Central banks around the world are buying gold at a record pace. In 2025 alone, central bank purchases surged dramatically. Total gold investment demand soared to a record 2,175 tons. Why? Because countries like China, Russia, India, Turkey, and others are quietly, but aggressively, reducing their dependence on the US dollar. This process is called de-dollarization. These nations saw what happened to Russia's dollar reserves after sanctions and want their reserves in something that no government can freeze, sanction, or print more of. Gold's share of global reserves has climbed significantly in just a few years. That structural buying is one of the most powerful engines underneath this gold rally, and it isn't stopping anytime soon. Trade tensions are another factor. High import tariffs and global trade uncertainty are reshaping supply chains, raising costs across industries, and creating instability in economic planning. When recession risks rise and uncertainty spreads through global markets, gold demand rises with it. Let's spend a moment on the Iran war specifically, because this is the newest and most rapidly evolving economic shock, and most Americans are only beginning to understand its full reach. The war began with strikes on February 28, 2026. Within days, the economic shockwaves were felt from Wall Street to Main Street. Brent crude oil prices surged. Iran's Revolutionary Guard declared the Strait of Hormuz closed. Around 20% of the world's oil normally flows through that narrow waterway. When it's threatened, the entire global economy feels the shock. Economists warn that a prolonged conflict could push oil above $100 per barrel, which would place enormous pressure on an already fragile global economy dealing with inflation and slowing growth. Different scenarios paint very different outcomes. A short conflict could cause only temporary price spikes and mild economic disruption. A medium-length conflict lasting several weeks could produce meaningful economic damage and sustained inflation pressure. A prolonged war could cause major economic harm across multiple economies. As of early March 2026, experts remain divided on how long the conflict might last. Even military escorts for oil tankers have not completely calmed market fears. Let's step back and look at the broader U.S. economy. The labor market has been relatively resilient. In January 2026, the economy added roughly 130,000 jobs, and the unemployment rate edged down slightly to around 4.3%. Inflation is still hovering above the Federal Reserve's target. Economic growth slowed significantly toward the end of 2025, with annualized growth around 1.4%. Forecasts for 2026 have been revised downward as oil prices rise and uncertainty spreads through global markets. Wage growth has slowed and affordability pressures continue to build for households across the country. In plain terms, Americans are still working, but the cost of living remains stubbornly high and economic confidence has softened. So what does gold above $5,000 actually mean for everyday Americans? First, it signals pressure on purchasing power. When gold surges this dramatically, markets are often expressing concern about the long-term strength of currencies and the persistence of inflation. When the dollar weakens or inflation rises, everyday goods become more expensive. Second, it has implications for investment portfolios and retirement savings. Stock markets can become volatile during geopolitical crises and economic uncertainty. Assets tied to gold have historically performed well during those periods, although investment decisions should always be made carefully and with professional advice. Third, higher oil prices ripple through the entire economy. Oil fuels transportation, manufacturing, heating, and logistics. When oil prices jump sharply, those costs move through supply chains and eventually show up in the prices consumers pay. Looking globally, gold demand has reached historic levels. Investors and central banks around the world have been increasing their gold holdings at the fastest pace seen in decades. Many countries are gradually diversifying reserves away from a heavy reliance on U.S. Treasury assets and toward physical gold. This does not mean the dollar disappears as the world's reserve currency overnight, but it does signal a shifting balance in the global financial system. The geopolitical situation in the Middle East adds another layer of uncertainty to energy markets, trade routes, and economic stability across multiple regions. So what are major financial institutions expecting next? Several large banks believe the forces driving gold higher could continue for years. Structural demand from central banks, geopolitical risk, and persistent inflation concerns remain powerful drivers. Some analysts believe gold could continue climbing if global tensions escalate or if inflation proves harder to control than policymakers expect. In other words, the rally may not be over. Here's the bottom line. Gold has always acted as a signal. For thousands of years, it has reflected moments when economies are under pressure, currencies are being questioned, and global uncertainty is rising. At more than $5,000 per ounce, gold is sending a very loud signal. It reflects geopolitical conflict, inflation concerns, shifting global power dynamics, and an economy navigating multiple risks at once. None of this means panic. Economies have faced shocks before and recovered many times. But it does mean awareness. It means paying attention to the signals markets are sending and understanding how global events connect to everyday life. The price of gold isn't just a number on a chart, it's a mirror reflecting the condition of the world economy. And right now, that mirror shows a world under pressure, a world changing rapidly, and a world where staying informed matters more than ever. Stay informed, stay engaged, and we'll see you in the next video.